In today's video, we're going to be going over 3 ways that you can leverage your primary house or one of your properties so that you can purchase more rental property. So make sure to stick around to the end because these are steps that you can take today. Also at the very end, I'm going to be going over how I was able to leverage one of my properties to purchase another rental property with $0 out of my pocket. So stick around for that. Oh, and guess what? I'm not special. You can do it too. What's up, everybody? Welcome back to my channel. My name is Evan Phoenix, and this channel is all about real estate investing. So if that's something that you are interested in, why don't you go down and subscribe to this channel? So all you Dave Ramsey fans out there, I know you're ready to get in the comment section and type, debt is bad. Debt is not your friend. You should not be leveraging one property to buy the rest, pay off everything. But slow down. Just hear me out real quick. Although Dave Ramsey's methodology is a great way to prevent yourself from a bad financial situation by utilizing bad debt, I'm actually going to be talking about how you can leverage one of your properties to purchase another property that cash flows and pays you every single month. I like to call this good debt. Now, when I say good debt, let me explain. There's good debt and then there's bad debt. Good debt is defined as money owed for things that can help build wealth or increase income over time, such as student loans, mortgages, or a business loan. Bad debt refers to other things like credit cards and other consumer debt that do little to improve your financial outcome. For example, let's say you took $60,000 out for a personal loan from the bank, and you decide to use that $60,000 towards a brand new sports car that's not going to make you any money whatsoever. You just want to keep up with the Joneses. This is considered bad debt because now you are liable for that $60,000 sports car, and you probably have a monthly payment that is pretty hefty on it as well. And each month you're paying towards it with no financial gain. But let's say you took that $60,000 and you put it into one of your businesses. Let's just say you have too many lawns to cut in your landscaping company and you need to hire out more people so that you can manage that many yards that's needed. You go out, you buy equipment, you buy trucks, and you hire the crew necessary to do a ton more. This is considered good debt because not only are you raising the amount of yards that you're able to do and income that the business produces, you're also raising the value of the business as well. So with that being said, let's get into the 3 ways that you can leverage your property today if you have equity in them. The first one we're going to be going over is a home equity line of credit, a HELOC. Now, every situation is different, so for this instance, we're going to be using the same one. Let's just say that you own a property that's worth $250,000 and you owe $200,000 on that property. You are able to take some of that $50,000, if not all, and use that equity to go purchase more property so that you can scale your business and raise the amount of cash flow that you're getting by utilizing the good debt. A HELOC basically is like a credit card. You will get a limit for how much equity in your house that you're able to utilize. From a primary home perspective, I've seen anywhere from 80 to 100% of the equity in your home you're actually able to pull out into a HELOC, but every bank's different, so make sure to shop around when that time comes. The great thing about a HELOC is that you can get approved for, let's say, a $50,000 HELOC, but you don't have to use it that instance and you do not pay on it once you get approved. Let's say I get approved for a $50,000 HELOC and I don't touch it for 3 years, I don't have to pay anything. It's only when you use some or all of the proceeds of that $50,000 HELOC that you'll actually have to pay on a monthly payment. From what I've seen, it's typically over 20 years. The first 10 years is interest only, and the second 10 years will be paying off the principal of the loan. But you could actually pay it off earlier if you would like to. So back to my scenario. Let's say that you own a $250,000 home and you have $200,000 owed on the property. That means you have $50,000 of equity. Now you go to a bank and they're offering you 100% loan to value on your equity in your property. So you're able to pull out $50,000. Now with that $50,000 home equity line of credit that you just received, you can go buy another $250,000 property with 20% down. Make sure to add in your calculations the interest that you will be paying in the payment, whether that's if you want to pay the principal and interest every single month or just the interest on the HELOC. Include that in your number so you can see actually how much you're going to cash flow. But this is a great way. If you're trying to leverage an investment property, at max, I've seen 80% loan to value. So you wouldn't be able to pull that full 100% for a HELOC. I've seen up to 80%, and that's pushing it. The reason being is that investment properties are a little bit more risky for the banks. Okay, so let's move on to number 2, which is a cash out refinance. A cash out refinance is very similar to a HELOC in terms of how much money you can take out with the loan to value, but it's basically a brand new loan. So you are trading in your $200,000 loan for your, let's just say, $240,000 loan, meaning that you will get a new interest rate. You will get probably a higher payment if you're taking out more money, but in turn, you will get a lump sum of money that is absolutely tax-free. And that is not a loan that goes right into your bank account. You can use it for whatever you'd like. Typically for a primary residence, I've seen as high as 85% on a cash out refinance. So if we take our example from before, you own a property that's $250,000 and you owe $200,000 on the mortgage. So you would be able to cash out refinance 85% of that $250,000. You subtract the mortgage that you still owe on the property, and that's about $12,500. That's $12,500 that you can take out, put in your bank account, and then use toward either investing in yourself, investing in a business, or buying more property. On investment properties, it's even lower. I've seen anywhere from 70 to 75%, sometimes 80% of a cash out refinance for investment properties. And once again, that is because it's more risky than a primary home. Now, I hope you're understanding that this is just an example. I know that $12,500 is not that much that you can actually go and invest and get a good return on your investment. I just want you to understand the concept of it. Which leads me into my third and final, which is financing. From my experience, if you go to a commercial or federal credit union and it's one of their loan products, what they can do is actually take the equity and leverage one of your properties you already own if you are looking to purchase another. So let's say this same example, you have $50,000 of equity. Instead of having to take out a HELOC or going through the process of a cash out refinance, what they would do is leverage that property, take that $50,000 and just write it into a note and put it on this new property. So you're basically leveraging 100% of the property. The last thing you want to do is probably purchase a property that is not cash flowing or is even breaking even each month, just because cash flow will get you through tough times when something breaks in the property, let's say the hot water heater, or a capital expenditure like the roof or foundation needs fixing. Cash flow can really help with that. So those are the three ways you can leverage your property to buy more property. But I'd like to drive home one more point and one more example of how I was able to leverage my 4-unit apartment complex to purchase a duplex with $0 out of my pocket. So in 2020, I purchased a 4-unit apartment complex. What we did is we went in there, we bought it under market, we renovated the units, raised all the rents to market value, and then we got a new appraised value, which was higher than what we purchased it for. So we had the equity there. What we did is we ended up pulling out a HELOC on the property because a cash out refinance would have been too low. And at the time, it was our primary residence, so we were actually able to take more on our primary residence than if it was an investment. So for 2 years, we were sitting on this HELOC, waiting for the right opportunity. Earlier this year in 2022, we actually purchased a duplex right around the corner from this 4-unit. It was sitting on the market for a little bit, so we were able to use some creative financing by getting a seller credit, which I talk about in a lot of my videos. So if you're interested in that, you can go into the link below where I talk about how I was able to purchase that property with $0 using seller financing. I'm not going to get that much into it in this video, just want to understand the concept. But with that seller finance that I was able to use as the down payment on the duplex, I only had to come to closing with $19,000. And my HELOC more than covered that. So I actually brought $0 out of pocket to the closing. I leveraged the property fully, but it still cash flows about $700 every single month. And that's more than enough to stuff in my bank account and just let it grow over time in case something were to happen to the property or I'd have to pay off the loan. Once again, I just want to preface, make sure to run these numbers and get the correct numbers into your spreadsheet so you know if you're buying a rental property, how much you're actually going to have to pay. Like I said, the HELOC, it does interest only for the first 10 years, and then after that, it will increase. So just want to make sure you talk to your lender and understand fully what the HELOC entails, as well as leveraging your property or a cash out refinance. I hope this helped in some way possible, and I want to thank everyone that stayed to the end to watch. If you like this, please go down, give me a thumbs up, and subscribe to my channel. It's all about real estate investing. All right, guys, I'll see you in the next one. Peace.